Everywhere there is news about the all-time high of Nifty 50 and BSE Sensex. But a couple of days ago, that is on 30th of July, Nifty Small Cap 250 Index also made a lifetime high of 10,977. And also, since last few months, record amount of money is being poured into small cap funds. So, in such a euphoric market conditions, let's review one of the top rated small cap funds, that is Quant Small Cap Fund, and try to understand that should we continue our investment or redeem this fund now? And if planning to start a new investment, then should you start in this fund or should look for other funds? So please watch the video till the end. Hello everyone, I am Dhaval and welcome to my channel DIY Finance. Earlier also, I have done a detailed review of this fund in December 2022. Link is attached in the I button and in the description. So let's start the video. Here we will be taking into consideration data of direct plans only. First, let's look at the basic details like the AUM, that is total asset under management, which is around 5,500 crores. In December of 2022, when I had done a review of this fund, it was just 2,600 crores, which clearly states that the AUM has more than doubled in last 6 to 7 months. This is not only with Quant, but also with other small cap funds, where there is a huge inflow of funds, and that is the reason recently Nippon has stopped accepting lump sum investments in their small cap scheme, while the expense ratio is 0.62%, which is not too less but more or less average as compared to other schemes in the category. The benchmark index, that is the reference against which the scheme is compared, is Nifty Small Cap 250 TRI. Now let's look at the sector-wise allocation and compare it to its benchmark index. From the table, it is very clear that the fund is heavily invested in finance, followed by energy, services, healthcare, and consumer staples. And when compared to its category, its allocation is quite different. Here, we'll not go into much details of the sector-wise allocation, as the fund has a strategy to change stocks frequently. Now let's quickly look at top holdings and portfolio allocation. As evident, Reliance Industries is the main stock of energy sector, whereas HDFC Bank and Punjab National Bank are the main stocks of the financial sector. Newer listed company like Bikaji Foods is the main stock of consumer staple sector. Here, if you observe, though this being a small cap fund, the top two highest weighted stocks are large cap stocks. Here, I would again remind you that the fund has a strategy of changing stocks very frequently. The now two top stocks in the portfolio were nowhere seen in the portfolio when I did my last review of this fund in December 2022. So now let's look at the portfolio allocation. On checking the portfolio allocation, it is evident that the small cap shares form around 56% of the portfolio, whereas mid cap shares form other 18% of the portfolio, and rest 25% is allocated to large cap stocks. Generally, it has been observed that small cap funds do not have such high exposure to large cap stocks, but Quant has always been different in its approach, and that could be one of the reasons is having such an excellent performance track record. Generally, higher allocation to large cap stocks provide a lower volatility and an overall stability to the portfolio. There are 71 stocks in the portfolio, with top 10 stocks contributing to around 38% of the portfolio, and top 3 sectors contribute to only 30% of the portfolio. Here, there is no much concentration on stocks and sectors, which makes the portfolio quite manageable. The fund's PE and PB ratios also suggest most of the stocks in the portfolio are growth stocks, which can perform better in a rising market. The fund manager has increased the total number of stocks from around 60 to 71 stocks in last 6 months, and also increased its allocation in large cap stocks from 17% to 25%. This type of different strategies are being adopted by fund managers to cope up with the increasing AUM in the fund. So I feel that one should not much worry about the increasing AUM and continue their investment in the fund. Now let's look at the fund managers. Mr. Sanjeev Sharma has been managing the fund since October 2019, that is almost from the start of the scheme. Here, please note that in 2018, Quant took over the AMC from Escorts, and after taking over by Quant, lot of changes have been made in the scheme's attribute and fund managers. Hence, In future part of the video, we'll look all the data of last 5 years and less only. Mr. Sanjeev Sharma has been joined by Mr. Ankit Pandey in May 2020 and Mr. Vasav Saigal in April 2022. All three of them together have been managing not only the small cap fund but most of the schemes of Quant AMC, and that too quite efficiently, and hope that they continue in future also. Here, this long-standing association of the fund manager with the same scheme is quite positive and an advantage for the scheme. Now let's check the fund's performance. Firstly, the trailing returns. On comparing the trailing returns for 5 years, 3 years and 1 year, it is seen that the fund is able to beat its benchmark and the category with a very good margin. Here, I have ignored the data of 7 years and above as Quant took over the AMC from Escorts in 2018 only. And the new strategy was adopted by Quant Fund House only after that. Here, if you observe, the performance of the fund for 6 months and less is quite low and is not able to beat its index or the category, which is not a good sign. Surely, one should not take any decision based on short-term performance. The main reason, I feel, for the short-term poor performance is the tsunami which came after the Hindenburg report in January 2023. Quant Small Cap Fund had some exposure in Adani stocks at that time, which they have already exited now. Now let's also check the calendar returns and see how consistent the fund is in its performance. On checking the calendar returns from 2018 to 2022, it is very evident that the fund has outperformed its category and benchmark for the entire period except for 2019, which clearly indicates that the fund is quite consistent in its performance. Now let's also check the performance for this calendar year of 2023. Here also, if you observe, the fund started the year with a good performance, and for the most part of January 2023, it had performed well. But after the Hindenburg report in the end of January 2023, it has not been able to beat its category or index, but it is almost same as that of its index and the category. Hope before the end of 2023, it is again able to outperform its index and the category. Now let's also see the rolling returns. Here we have rolling returns data for 1 year, 3 year and 5 years. And on checking the 1 year rolling returns, the fund is able to beat its index 81% of times with an average return of 31.81. Here the standard deviation is 58%, which is quite high, and such high values make small cap funds highly volatile, which is the reason we term them very risky in short term. On checking the 3 years rolling return, the fund is able to beat its index 64% of times with negative return chance of 21.37%. And for 5 years rolling returns, the fund is able to beat its index 60% of times with negative return chance of 10%. Surely, the rolling returns data for the fund is good, but not the best in the category. Now let's see how the fund performs on risk parameters. Here, we compare the parameters with the benchmark index and the category average. First, the mean return, that is, the average return in a year, which is 50.33, which is far more than both the category average and the benchmark. Here, higher the value is better. Second one, standard deviation, that is a tool to measure how much the returns have deviated away from the mean returns, which in this case is 22.45, which is more than both the benchmark index and the category average. Here, lower the value is better. Third one, Sharpe ratio, that is a tool to measure the risk adjusted returns, which is 2.06, which is more than both the benchmark index and the category average. Here, higher the value is better. Fourth one, beta, that is the volatility of the scheme compared to the benchmark, which is 0.94, which is more than the category average. Here, lower the value is better. Fifth one, alpha, that is the tool that measures how much better the fund has performed compared to its category. Here, it is 17.10, which is far more than the category average. Here, after looking at the risk parameters, it can be concluded that the fund's performance is quite good as compared to its benchmark and the category, but this comes with a higher volatility. Now let's see the upside and downside capture ratios. The upside capture ratio is the measure of how the fund performed relative to the index during the period when the index rose. Here, the value is 123, which indicates that the fund outperformed 23% more than the index during the rise period. Here, higher the value is better and should generally be more than 100. The downside capture ratio is the measure of how the fund performed relative to the index during the period when the index has dropped. Here, the value is 64, which indicates that the fund declined 64% as compared to the index during the fall period. Here, lower the value is better. Here, the upside capture ratio is quite good, whereas downside capture ratio is okay. And funds with this type of risk ratios perform better in a rising market. So now coming to the conclusion, what investors should do. But before concluding this video and suggest what investors should do, I would request all of you that as you have watched the video till now, it seems that the topic is of your interest. Hence, I would request all of you to press the like button and also subscribe to my channel if you have not done till now to watch such interesting videos in future also. So now let's look at what investors should do. First, the existing investors. The fund has been performing quite good since last almost 4 to 5 years, but has been underperforming since last 6 months. And this short-term underperformance should not be a reason of much worry. And so I feel that existing investors should continue their investment in this fund. There is a buzz in the market that huge money is flowing in small cap funds. And as the funds have given very good returns in last few years, there will be a little cooling down and one should withdraw partially from small cap funds. But I don't feel that this is the right strategy. You should continue your investment and leave the pressure on fund managers to outperform in coming times. Fund managers adopt different strategies as discussed earlier in the portfolio allocation section to cope up with the rising AUM. Second, the new investors. Surely, the fund has been underperforming since last 6 months, especially after the Hindenburg report in late January 2023. But looking at the excellent past track record of the fund's performance, and this underperformance due to external condition should not hamper the performance of the fund. So I feel that one can start a new investment in this fund if your investment horizon is of at least 7 to 10 years. But one should avoid lump sum investment in this fund at this time. I would like to add that I have Quant small cap fund in my portfolio and will be continuing my investment till my next review of this fund. Do check my older videos. Click the attached cards to watch the video. Thank you.